statement. And we want those expenses to show up in the same month as the revenue they produce. Does that sound about right? Now, let's take this one step further. So July, August 1, so August 2nd is payday, right? So this is the adjusting entry. This is payday. So 100, 100. So now, we're going to have salary payable of 300, salary expense, and I'll write EXP for expense 200, and cash will be credited for 500. That sound about right? Yeah.
And above the, this is payday to the left, why do you have it there?
That's payday. That's Friday. So this is July 31st, August 1, August 2. So what we're doing now is we're paying the payroll. That make sense? Now, this chapter deals with adjusting entries. This is the adjusting entries, and our goal is to put this $300 in the income statement that ends July 31st. That's what we want to do here, okay? And the revenue for July will also be in that income statement, okay? And then it's the matching principle, and those expenses will be matched to the revenue they produce, okay? So they obviously do this whole thing. Now, it's a payable at this point in time. Now, that means it's a liability. Now, 2 days in the future, you're going to pay it. But as of Wednesday, you owe it. And then you'll pay it 2 days in the future. And so your balance sheet will have this liability, your income statement will have this expense. Now, 2 days pass and it's a payday, right? So when it's payday, which is August 2nd, so July, August 1, 2, you're going to pay this liability. You're going to have the expense for those 2 days, and then of course, credit cash $500, this is what you pay your people. That sound pretty good? And this is an accrued expense because they just keep accumulating, right? Now, I'll explain in a minute. This is an accrued expense, and that's a deferred expense. The ones we just worked with are called deferred expenses. And this is an accrued expense. And I'll explain why they're different in just a minute. Let me just introduce it now. All right. So, are there any questions? Yeah.
Why is the salary pay, the liability 300?
Right here, because it's 1, 2, 3.
But I thought you've already paid that.
No, so at this point in time, we have not paid it. This has not occurred yet. So the adjustment puts these three in expenses, and that's our main goal in this whole thing. But every debit has to have a credit, right? Okay, and so here's the credit. And it's true, you owe it. Okay, then in the next period, you pay it. And so now, these two will show up as an expense of August. And so you're paying off some of the debt, you still owe some of the liability from July, the expenses of August, and credit to cash. Yeah, and these are good questions. Any others? All right. Yeah.
So there are those two transactions that you just generalized, they're gonna both be in the adjusted entry.
No, this is the only adjustment.
And then,
And this is just payday. But this is the adjustment. And again, and let me just kind of make sure you're getting a good answer here. Don't forget, adjustments are part of the accrual system, and the accrual system says we're going to declare expenses and revenues when they occur. And when we do that, then we match the expenses to the revenue they produce. That sound good? Okay. All right, let's do this. Let's do quick study 3-5. You find that on page 118. All right, can you put that on the board? 118, and it was 3.5, that's this one. I'm gonna fold this in half so it lays a little better, it's easier to read. Okay, so here's 3.5. So what we have here is Marcia Motor employs one, oh, let's see, I'm gonna wait for the outpost to get up there. All right. Marcia Motor employs one college student every summer in her coffee shop. The student works the 5 weekdays and is paid the following Monday. For example, a student who works Monday through Friday, June 1st through June 5th, is paid for that week on Monday, June 8th. Okay? Motor adjusts her books monthly, if needed, to show salaries earned but unpaid at the end of the month. The student works the last week of July. Friday is August 1st. If the student earns $100 per day, what adjusting entry must Motor make July 31st to correctly record salary expense for July? All right, how's that sound? And by the way, R here stands for Thursday. So $100 a day for 4 days, Monday through Thursday. So salary expense is debited for 400, salaries payable is credited for 400. And that's an accrued expense. Are there any questions? All right, let's do this. You guys are okay with that? Let's do exercise 3.6. And we find that on page 121. So, all right. Pablo Management has 5 part-time employees, each of whom earns $100 a day. They are normally paid on Fridays and work completed Monday through Friday of the same week. Okay, they are paid in full. They were paid in full Friday, December 28th. The next week, the 5 employees worked only 4 days because New Year's Day was an unpaid holiday. Show the adjusting entry that would be recorded Monday, December 31st, and B, the journal entry that would be made to record the payment on Friday. so here's the adjusting entry. So to record the accrued wages for one day, that would be the Monday, right? 5 workers at $100 a day for one day, it's $500. So the deal is, this is the one day, this is Monday, right? So that one day's wages expense will show up on the December income statement. The income statement ending December 31st. And when they pay it, it looks like this. And the only thing that's a little complicated about this is there's only 4 days in this week because Tuesday is a holiday. Okay? So in this case, here's the wages payable from the adjustment. And here is the remaining 3 days. And here's pay for 4 days. And the only thing that's complicated, of course, is the fact that Tuesday is January 1st, and that's a holiday. Any questions, anything? You guys, we're at a pretty good stopping place. Should we take our 10-minute break, come back? Or would you rather work through the break and get out 10 minutes early? Who wants a break? Who wants to get out 10 minutes early? All right, get out 10 minutes early then? Sound good?
Yeah.
All right, sounds good, okay. So let's go on to the next topic here. I'm gonna move that camera around. And if you need to take a break, feel free to do so. Okay, now let me take a look here. How far does that go? Okay. All right, so let's get on to another accrued expense. Okay, and by the way, these are deferrals. And those are accruals. And I'll explain why. I'll explain the difference in a minute. So, in this case, let's see, I've got this, I've got that. Let me turn the light on. All right, so in this case, what happens now is, here's the scenario. They borrowed $6,000, okay? They signed a note, and they did that on December 1st. They signed a note for 6%. Okay? Now, the way this works is, and then on December 31st is the end of the fiscal year. So there's going to be an adjustment. December 31st is the end of the fiscal year. Now, what happens here is there's 31 days in December. This was signed on the 1st. So if there's 31 days in December, and this was signed on the 1st, when you sign a note, there's no interest. So that means there's 30 days of interest. Okay, so they signed it on the 1st, right? And there's 31 days in December, so that means 31 minus 1, there's 30 days of interest, okay, in December. So, interest equals principal times rate times time. So in this case, the principal is 6,000. The rate is 6%, and the time is 30/360. Now, This book, on the quizzes, on the tests, in the homework, uses the 360-day year. This is called the banker's year. And the banker's year is the one they use. Now, what happens in this thing, the excuse is, listen, it's just tough to deal with 365. Let's deal with 360 just because it's an easier number to work with. And this really was used up until, maybe 10 years ago or something like that. Right, when you guys do it on the job, you'll do it with 365 because calculators, Excel, etc. like that. In reality, it's true that it was easier to work with, but the reason they did it is slightly to the advantage of the banker. And so it's not enough money that you're going to fight them over, right? But a dollar or two here, a dollar or two there, and you do that with thousands of loans over centuries, it adds up, okay? But whenever you guys do it, use the banker's year, 360 for this book, okay? Now, it turns out 6,000 times 6% times 360, that turns out to be $30, okay? So you have interest expense of $30 and interest payable of $30. Okay, does that make sense? And again, what you want to do is you want to put this expense in the accounting period when it occurs, right? And you'll have the revenue, you'll put it in the same accounting period. That's the object of this whole thing. Does that sound good? All right. Now, so any questions, anything? Let's do a little bit of practice. Let's do exercise 3-2. You find that on page 120. And let's do number G. And the reason we're doing that is the only one I could find. I'll turn the camera around. Thank you. All right, so it's page 120. Well, man, you guys, they don't have the faith in you that I do. This is too simple a one, but it'll do the trick, but it's the only one I could find. The company's earned but now recorded $750 of interest from investments in CDs for the year ended December 31st. The interest, oh, is that revenue? Oh, no, I want G. Never mind. Well, hey, you guys, it'll work the same way, but it'll be in the opposite direction. So the company has a bank loan and has incurred but not recorded interest expense of $3,500 for the year ended December 31st. The company must pay the interest in January, okay? So this is the amount of interest they accrue. All right, how's this? Sound like a plan? right, so those are accrued expenses. Let's get into accrued revenues. Excuse me, there, sir. Let's get into accrued expenses, or accrued revenues. Okay? All right, I'm going to turn this on. Can I get past you guys and I'll turn my camera around? Thank you. All right. Now, here's the thing. Suppose you build dams, right? So you build dams. And this city contracts to build a dam, and it's going to take you 5 years. When it's built, they're going to pay you $5 million. Okay, but you don't get a penny until it's built. Now, 1 year passes, and you say, listen, I've completed about 1/5 of this dam. So, if they're going to pay you $5 million, okay, and you're about 1/5 done, you say, it seems to me that I've earned $1 million. Okay? So what you want to do with that is you want to have some sort of a receivable. So on December 31st, you want to have some sort of a receivable. Now, accounts receivable is the one your textbook uses, and it's really not ideal. Accounts receivable is normally you completed a job, you sent a bill, you're waiting for your money, right? You could have like dam revenue receivable or something, but just be prepared. And just be prepared to use accounts receivable, even though it doesn't quite match. Okay. Now, but what happens there is, on the accounts, you can only use the accounts that are in your ledger. Only those that are in your chart of accounts, none other. You'll look at your ledger, you look at your kind of receipts, and this is the only one that can possibly be used, even though it's, let's face it, it's not ideal. Okay. And so accounts receivable, $1 million, and we'll call this dam building revenue. $1 million. And so what you're doing here now is you're estimating how much you've earned, and you're calling that as revenue. Now, suppose you didn't do this, what would happen? Well, you'd have the expenses. You pay them, you know how much you paid for the expense, right? Your bill showed up, etc. But you'd have no corresponding revenue, and your income statement would make no sense. Then in the 5th year, you'd only have 1 year's of expenses, and you'd have 5 years of revenue. It wouldn't make any sense either. So with the accrual basis, you declare the revenue when it's earned, and there'll be some sort of a receivable. Another way of looking at this, at the end on December 31st, and we'll make this 2011 just so we got a date in here, the city calls you up and says, hey, listen, we changed our mind, we don't want the dam anymore. You say, fine, you owe me $1 million, because that's what I've earned. It's another way of looking at it, okay? But again, that's the asset, but our interest is the income statement, our interest is the revenue. And we have to have a corresponding asset. Here we have to have a corresponding payable, okay? All right, so another example of this thing is accrued service revenue. So this is accrued revenue. So notice we have accrued revenue, we have accrued expenses, and over there we have deferred expenses, okay? So what it is, okay, so what you want to do is just declare the amount that you've earned in the period when you've actually earned it. Now, it seemed to me, and I don't know why I didn't write this down, that we have one of those we can use here. So let's take a look here. So let's do F. And what F does is F is an accrued revenue. Now this accrued revenue is different. It's not a job per se. It's a CD. But again, what you're doing here now is you're declaring the revenue in the period when it occurs. Okay? I'll turn on that light so it's easier to read. How does this look? In this case, it's interest receivable and interest revenue. But what you do is the amount you've earned shows up as a credit to revenue. In this case, it's interest revenue, right? And there has to be a corresponding asset, interest receivable. So at this point in time, suppose you cashed in the CD and suppose there was no early penalty, this is the amount you owe. Okay? Does that sound good? All right. Now, let's do this. We covered, let me turn on that light. So let's have a quick, so what I'd like to do now is let's have a quick review, and then we've covered a lot of material here. Look at, is it Emily? Emily looks like that. Have you regretted voting for to go with the break? No? Okay, you're going to get through it. All right, she just kind of looked like she kind of wished man I would, but is it Ashley? No, Ashley? No. Never mind. All right. All right, okay. Take me a while. All right. Anyway, so you guys, so let's do this. Let's have a quick review, and then we'll practice some of these, because we've covered a lot of material today, right? Now, there is one topic that I brought up that I'd like to cover. Let's have a review, and then we'll spend the rest of the class practicing all that we've learned. Because we've covered, you guys have covered a lot of material today. So if I were you, I'd need some consolidation, which is just practice. Let's cover one more topic here before we go on. In fact, I think I'll do it up here and I won't have to move the camera. So here's the other topic. We had accruals and we had deferrals. So accruals and deferrals. So the accruals are over here on this board. And what the deferrals are over on this board, the accruals are on that board. And the difference is, it's a matter of when the money changes hands and the entry's made. So here, what you do is you pay. Oh, wait a second. I do have to cover one more before we go back, and it's the unearned revenue account. Okay. Why did we skip that one? All right, I'll cover the unearned revenue. Huh. I'm not sure why we didn't do that. Okay, we have one more time. Here's the deal. On a deferral, you pay or receive cash, then you recognize the transaction. And so in this case, what we did is we bought an asset, we bought the car, we paid for the insurance policy, we bought the supplies. We did that first, and then we recognized the depreciation, we recognized the expiration of insurance, we recognized the supplies were used. So the money first, transaction second. Here is the reverse. Transaction before cash. So here, what we did with salaries, here we recognized the salary expense first, and then we paid it on payday. Here, we recognize the interest at the end of the year, and we'll pay, and we'll pay it sometime in the following year. Here, we recognize that we've earned the money, but we'll receive the money. So deferrals, with accruals, these are accruals, you recognize, you record the transaction, then the cash changes hands. With deferrals, the cash changes hands, then you recognize it. That's the difference between the two. Okay? Now, we also had one topic that I'm not sure how we missed over, but one other thing needs to be adjusted. You guys remember unearned revenue? So let's say you have a service business and you get paid in advance. Let's say you're a lawyer, right? It's a retainer. So one of your clients says, your retaining fee is $100 a month. And so I want you always there. If I need anything, I have priority. So what happens on this thing is, and so you receive, and let's make it $1,000 a month, okay? You receive $12,000 for a retainer fee, and that's for a year, okay? Now, that means that if I have anything, I want you to look at a contract, I want you to ask, how should I proceed in this case? You'll answer my phone call, right? Okay. Now, there's a limit to this. I won't take up more than 10 minutes of your time for this $1,000 bucks, but whatever, right? So, but you'll be available for this. So what happens is when you receive the money, and let's say this is July 1st, you debit cash for the $12,000, and you credit unearned revenue for the $12,000. So this should be pretty much reviewed. So don't forget, unearned revenue is what kind of an account? It's a liability. It represents a prepayment. When you receive an advance payment, like this lawyer did, you've incurred a liability. It's not your money at that point in time. So then July 31st comes by, 1 month has been used up, and so now you have unearned revenue is debited for the amount that you do not owe, and service revenue or client fees, or maybe client revenue, or we'll make it legal revenue. Legal services revenue is a good name or something like that. $1,000. So now what happens is what you want to do is you want to declare, here you received the prepayment, here you earned it, here you incurred a liability, here you lessened your liability, and you're converting this liability into a revenue. That sound about right? Everybody doing good on that? All right. Questions, comments? Let's do this. Let's. We've gone over a lot in here. Let's go ahead and start consolidating with some practice. So here's some things that pretty much cover all that we've done. Let me see, where did I put my notes? Here they are. So let's, and by the way, with this next part, if you guys collaborate with each other, get back in your groups, it'll probably go a little faster. So let's do exercise 3-2, and we'll do that on page 120. Okay? And we've done a couple of these already. So here's how it reads. And the object of this is to kind of consolidate all that we learned. Would you guys like a review before you start? Are you ready to dig in? Emily's ready to dig in, right? You're doing good too? All right. Wish I had all the names down.
I'm Ashley.
You're Ashley. All right, you're Ashley. Now yours starts with an A2. You're Ashley, okay. I'll get it. All right. Okay. All right. Sound good? You're Ashley. All right. You guys want to review? You want to dig in? I hear dig in. Does that sound about right? Sarah, you want to dig in? You don't care? Sarah, you're honest.
Yeah.
Would you like to review, or how would you like to proceed? You want to review helpful?
Well, no, I was like, I'm jumping ahead and I have a question on the homework. Like, on part of like prepaid insurance, there's 3 insurance
Yeah.
policies and all that stuff, and I have a question about it.
Sarah, how does this sound? why don't we, now what I plan on doing next time is let's do the homework. We'll do the B version of the homework. And you're right, that insurance, that it's like, I think it's the second or third one, it is complicated. But what surprises me is as soon as I walk you through it, you'll go, yeah. So how, if you're okay with that, let's hold off till tomorrow or till next class, and we'll walk you through that. Good. Anybody else? All right. Well, listen, let's go ahead and just jump into it, and then I will have as always, I'll have a review before we leave to kind of move it into long-term memory. So let's do this then. Here's 3-2, and what they do on this is I'll turn up that light. We're going to get you started. And I'll put these up as we go along to give you feedback. So let me turn the slide. So here's how it reads. It says, for each of the following separate cases, prepare adjusting entries required for financial statements for the year ended. Assuming that prepaid expenses are initially recorded in asset accounts, of course we're talking about like prepaid insurance, supplies, automobile, okay? Assume our initially recorded asset, and that fees collected in advance of work are initially recorded as liabilities. So when you receive a prepayment, that's unearned revenue is what they're saying there. The first one is 1/3 of the work related to a $30,000 cash received in advance is performed. So it says you receive $30,000 in cash, you debited cash, credited an unearned revenue account. Now you've earned 1/3 of that, and that's the adjusting entry. Is that a good enough starting place for you guys? All right. And so here's the first one, so what kind of a hit? So you've earned 1/3 of it, so you debit the liability and you credit the revenue. Yes. That's a liability, and it's money you've received that you have not earned. It's,
Instead that we earn 1/3.
well, unearned fee revenue is a liability account, right? So when you earn it, and liabilities have a credit balance, so now you've earned it, so you lessen it together. And he isn't, accounting's not difficult, but you have to do work with it. Most of the time, first of all, that does happen at the time of the union, so that'll end at some point. Yeah. And you do.
Is it that way you started with?
Here's what you do when you start a business, and you use a computerized system. So like Beach Street QuickBooks, but they all kind of work the same. If you set up a business, you spend, and part of that is, they'll ask you what kind of a business is it, service station, bakery, whatever. So you put service station. So they'll give you a chart of accounts that they'll probably use. Now the way they do it is they give you more accounts than you'll ever use. So what you do is you go through, just because it's easier to delete an account than to do an account, so there'll be more accounts you'll ever use. Go through there and delete the ones you probably never have a use for, and change the title so you actually get those that are left. You change the title so you match your exact business. And that's the way we'll do it. Oh, like my name, I would have Steve Walter Common Capital, Steve Walter Common Drive. If it was a sole proprietorship. Well, that's kind of a general one. Suppose you were a magazine publisher, you'd say honor subscription revenue. Or suppose you were a lawyer, honor legal fees. Yeah, and again, if you're carefully choosing the titles, it'll make sure it makes bookkeeping so much easier, such that when somebody reads the financial statement, they know what you need. These are good questions. Let me put up a few more of these. All right, so here's the first couple of these. How does that work out? See if there's any questions. Yeah, Dave?
On like the depreciation and accounting depreciation, you always specify which.
Here's the way this works is, don't be surprised if there's just one depreciation expense account, right? However, the contra asset always has to be paired with its corresponding asset. So you'll always see accumulated depreciation equipment or accumulated depreciation auto. So on the balance sheet, this will be paired with its corresponding asset. So it will always have an identifier.
Okay, so but let's say there's no accumulation depreciation, let's say an auto, that wouldn't add to the 19,127, that would be another separate for the accumulated depreciation auto.
I'm not sure which.
If there was another depreciation later on, let's say it was the auto, would that add to the 19,127 or be its own separate?
Yeah, one separate. So suppose you also had a car, right? So you have equipment and car. So you have accumulated depreciation equipment, you'll have accumulated depreciation dash auto. And then this will be, on the balance sheet, this will be paired with its asset to show how much is left. The auto will be paired with the auto to show how much the auto is left. Then when the reader looks at that balance sheet, they can say, these people are going to have to replace these assets really quick. Let's take a look at their cash. Do they have the wherewithal to buy it? And if their assets are worn out, they have no cash, bad sign. So it allows you, so by being able to see how much of each asset is left, you can better evaluate their cash position. And that's why it's done that way. However, and just one other thing, is depreciation expense, a lot of times it doesn't make any difference. So you could have depreciation expense equipment, but often it's just one depreciation expense account. And the auto and the equipment just dump in that one, just because there's no point in separating it out.
So the expense we could accumulate.
Yeah, and by the way, they all accumulate.
Well, I mean, equipment and auto as opposed to those separately accumulated in separate depreciation expense accounts.
Exactly. Yep. All right. You ready for some more? Now let me do this, I'll move this up here. And the reason I'm moving it along is because some of these we did by way of example. When we were, by way of practice when we did it.
Mr. Wolf,
Yeah.
if we're not getting the exact title, like for supplies expense, I just put supplies expense, not office supplies. Does that work too?
Here's the deal. Let me give you a good answer. What you do is when you're keeping books, you go to the chart of accounts and you can use those accounts and only those accounts and none other. Okay? So when you do a real set of books, you'll really have account titles and you're limited to using those. In here, not often, but occasionally, they ask you to make one up so anything possible will work. On the test, be sure to use the accounts that are given. Hey, by the way, let me share something else with you guys. There's 3 tests and a final in here. So the first test is by far the easiest. And I hate to say this because some people think it's easy, always study for it. No, work really hard, ace that one. Then when the other 2 come along and they're more difficult and maybe you won't do as well, you got that ace in your pocket. So really know this stuff, so you got that ace in your pocket. Because if I can avoid, giving anybody a bad grade, I'd love to do it. So get that ace in your back pocket, front pocket, whatever, right? And so make sure you got this down cold. And I hesitate to say that because I'll bet you somebody's saying it's an easy test, I won't study for it. No. Okay? I hate to say it's easy, it's just easier. Now, I'm going to check with you guys. Are there any questions? Well, let's go on and do 3.3 next. And it's just a general review. The next one down, so let's do 3.3. So it's exercise 3-3. And again, you find that on page 120, it's on the same page. And again, it'll ask you to do a series of adjustments. And I'll put the answers up as we go along. Now, they have a bottom part down here. It explains how they got the supplies adjustment. Let me offer it. Kristen. Here you are. There you go. Okay. Yeah, I'm just checking. You did good, thank you, Jesse.
I'm doing all right.